All right, all right, all right, all right. It is amazingly May 4th. Welcome to Wall Street Beats. I'm Benjamin Bry. This is Charlie Peabody. Looking sharp today, Charlie, and Bob Morris. Guys, we are at the point of exhaustion on the Iran headlines. Charlie was in the pre-show talking about how, the headlines took us down a little and then we came back. Now I'm seeing that bonds are selling on the news that the factory orders are up. Charlie, what's going on? What are we thinking about here?
No, we in the pre-market or pre-show we were talking a little bit about whether this market was exhausted and becoming sort of immune to the news in the Middle East, and by and large I would agree that it has. But when the military conflicts flare up, you do see a reaction in the S&Ps. This morning we had a headline from Iran that they had hit one of our warships, and the S&P futures sold off very rapidly, and then came back just as rapidly as it was denied. And then I think it was the UAE, later this morning, put out an alert for a missile alert, and the S&P sold off again, but came right back as that threat lessened. So the market is still sensitive to the possibility that this conflict can extend, but I think as long as crude stays reasonably tame, and now I'm more talking about the December contract, because that's the contract that everyone's looking at, and I'm going to turn this quickly over to Bob because he knows better than I do. But it seems to me that's the backwardation. People are basically saying higher crude prices aren't going to stay high for very long. But you've seen the December contract creep up from 70 to 80, and which means the market is starting to worry about a higher for longer crude oil prices. But I'll turn it over to Bob because he knows better than I do what the market is saying about crude.
Yeah, Charlie, you're right. I mean, if you look at the December-January contract, it's creeped up to $80 a barrel. It was sort of hanging around 75, and that continues to creep up as there appears to be no quick resolution, at least for now, to this conflict with Iran. And I think the only real card that Iran still holds is the Strait of Hormuz. And so that's where they're going to make noise and make threats. And when Trump announced that they were going to escort any stalled tankers or ships out of the Strait of Hormuz, Iran said, no, that's basically our territory. And if you do that, that's violating the ceasefire that's in place. And so, again, you've had no regime change, and we've said this over and over again. You've had no regime change. Yes, perhaps things are chaotic within the regime, within Iran, but you have had no regime change. And with the current regime in mullahs, they are not going to let go of their nuclear ambition. And we've said this before, it's a religious war to them. They're in this to the death. They're going to stall, and do whatever they can to try to reach some accord short of them giving up what they view their right to have nuclear capability and enriched uranium. So the market looks at that and says, yeah, you're right. We get it. And this is, the longer this lasts, the longer this, extends, the more likely it is that there's going to be this disruption to oil prices, the more likely we're going to hold on to this geopolitical premium until there is some clear resolution. And, this is becoming, a bigger and bigger issue for Trump week after week. This conflict or war has gone on for more than 60 days now. We're less than 5 months away from the midterms. And this is, in the polls, becoming less popular by the day. And in the meantime, yes, they're trying to put the economic stranglehold on Iran, and that seems to be the right direction to take for now. But we'll see how that plays out, and ultimately if it comes back to being a military intervention of some sort. But in the meantime, short of that, it's oil prices are going to hold up here, and you're going to have this geopolitical premium, and there doesn't still appear to be any quick resolution in terms of regime change or them raising the white flag.
Hey, Bob.
I mean,
Bob, do you?
go ahead.
No,
What do you have,
I
Charlie?
mean, I've been. No, I was going to ask Bob about nat gas because he's had a great call on EQT and EXE and a few others, and they've acted okay in recent months, but now they're starting to look like they're bid again. And I was just curious, is there
Yeah.
any
Yeah. And
observations?
I'm glad you brought that up. That's a good transition because I want to talk about natural gas. If you look at these names here, I think there's probably going to be less volatility now going forward, probably in the natural gas names versus the oil names. Now, the oil names can move sharply one way or the other depending on what oil prices do. And again, that's a wild card. It's uncertain what's going to happen here. But in the meantime, natural gas prices have been in the U.S. have been pretty much unaffected by what's going on in the Middle East for now. And we said last week that we thought for the year natural gas prices were near a low, and the natural gas names were more interesting, and we forecast that EQT would beat, and we were well above even the high end of the consensus on the street, and they beat our number. And then Expand Energy came in and beat too. So those names are increasingly interesting to us, and continue to like those names, especially with the uncertainty around oil prices. I feel better about there being limited downside to natural gas prices and upside in the long term, particularly starting the second half of this year between industrial demand, LNG, new LNG export facilities, and the AI power demand that everybody knows about that's coming. So, yeah, definitely EXE and Expand. I mean, EQT are my two favorite names. Continue to hold those. Would continue to be overweight those names. Now, in the meantime, what you're going to see from the oil names is you're going to continue to see likely beats. And we saw that from the gas names. We saw it from Chevron on production on Friday. And I think as we go forward, we're going to get EOG and Diamondback and others this week. I'm still expecting results to be near the high end of guidance, if not a beat on the high end of guidance from these names, just given the efficiency of the production from all these names on the oil side and the capture of that higher oil price for a month in the first quarter that I think the market still hasn't fully incorporated. So, estimates will continue to move up for the oil names in the meantime.
Bob, you mentioned the tie between nat gas and the AI data center build out, and I agree with you. There is a play there. I'm also involved in uranium, which again has been dead for months now, but looks like it's starting to gain a bid as well. At least the spot uranium price is. I know most of the real activity in terms of true activity occurs in the term market, not the spot market. But are you seeing? I guess where I'm going with this is, if the AI data center craze rolls over, and I know that's a big if, but if it does that take away from the bid on nat gas, or is there something else?
I don't think it takes away the bid because we haven't seen. It's still expectations. If I'm looking at the natural gas price today, the current spot market, we're still below $3. We're at $2.85. So I don't think $2.85 reflects any bid today from AI data centers. They're not in place. They're not buying that gas today. It's the expectation, the future expectation that they will step up. And, if I'm looking at, of course, in the middle of the winter, December, January, nat gas futures at around 430 to 475. Now, Feb 2027, is there a bid in it for 2027? Yes. And does the market look at the strip out in 27 on the valuations for these names? Yes, absolutely. So if there is a rollover in the AI data center demand, that's going to impact expectations longer term, and certainly would have some impact on the expectation for natural gas prices and perhaps these names that valuation wise, I don't think any of these names are reflecting $455 gas today anyway.
I think if I look out towards 28, 29, 30, there's a real strong bull case for uranium and nat gas related to these data centers.
Oh, absolutely. There's no question. I mean, if you look at all the charts and estimates, it's significant forecast demand increase. We're talking about 10, 15, 20% in some cases for nat gas.
Anyway, and what do you think? You want to keep? You want to moderate the show, Charlie? You're doing a good job, buddy.
No, I'm done. I'm done. I apologize.
Those are all good points, though. I mean, you're
John
spot on
wants
with
his
everything you
questions
said.
answered. He's like he's not waiting. He's impatient on this Monday morning.
I am.
Charlie, what's cooking on your side? What are we thinking of the banks?
Yeah, I'm a big believer that the banks are an important tell for the overall market. And they just reported an incredibly robust earnings season. We had what we call PPNR, pre-tax, pre-provision net revenues, up 15-16% year over year, which is that's total revenues minus expenses, excluding credit costs. And that's pretty robust for my industry. And we'll probably have another low to mid-teen type of growth here in the second quarter. What I find fascinating is that the banks sold off after the earnings season. And if you look at the XLF index, which is the broad financial services index, includes insurance companies, credit cards, consumer finance, et cetera, that index is off 8% from its February high. If you look at the KRE regional bank index, that's off 11.5% from its high, which was made back in 22. They didn't even make a new high here in 26. If you look at the BKX index, which is the big, bank index like JP Morgan, Citigroup, et cetera, that's off 4% from its February high. The only index in my world that has made a new high recently has been the XBD index, which is made up of capital market stocks. But now that's off 6% from its high just in the last week or two. The reason I think that's important is you have the S&P going to all-time new highs, and yet these financial services index, which are really reflections of the broader economy, are not making new highs. And I think that's an important tell. And then when you get down to individual names, like JP Morgan is sort of the lead steer in my industry. It's the best franchise, the best management, the best balance sheet. They've had incredible earnings strength for the last 5 years. They've outperformed the S&P in each of the last 3 years until this year. This year, they're down 3 or 4%, and the market's up 3 or 4 or 5%. So when the lead steer starts to divert from the broader market, that's telling you something. And I think what it's telling us is that we have a credit cycle coming. So my peak PPNR, peak revenues minus expenses, is decelerating into the second half of the year. Probably it's going to enter 27, running at a mid-single digit growth rate. But at that same time, I have the possibility that the corporate credit cycle is going to get worse. And so my credit provisions are going to go up, which means I'm at peak earnings right now. And I think that's what the banks are telling us. You throw on top of that, that their capital capacity now is being eaten up very rapidly by balance sheet growth. They're growing their balance sheet to support corporate loan demand and to support Wall Street in their prime brokerage business. And so that leaves less capital for buybacks. And buybacks have been a huge theme in this overall market, not just banks. But banks have been buying back 4 to 6 to 7% of their stock. They're going to be buying back less and less of their stock going forward. So I think the banks are an important tell as to where this market is headed in the second half of the year.
Yeah, I mean, I'm with you on that. I think that the banks are kind of the third sector of the economy, right? You have the public sector, the private sector, and then the financial sector. And, the reality is, I was talking about this last night in the podcast, was, if you just simply do the collect keep profit equation, CapEx booms lead to big profit booms, just from an accounting identity, right? And then you have the government deficits at like 1.9 trillion, the opposite of what he campaigned on, right? Anyone remember the word Doge? Like it feels like a long time ago now, right? So you have the government and the private sector CapEx boom just jamming, and I don't know, like you got to be really, really, really like bullish on things to be like, oh, this is gonna keep going at the pace it's going. And so I don't know. I'm with you, Charlie. I think we're close to the peak earnings. And I think that will be the most elusive and deceptive part of this, because I think most people are trained into looking at earnings being a linear move up since the GFC, more or less, right? They've taken the cyclical nature out of earnings, and maybe, I mean, who knows? But I'm telling you what, like as a bond bull, bond market's not reacting the way you want it to for just consistent deficits and then consistent massive like capex. So the Fed's clearly like on hold right now, and if this keeps going as it's going, and you got an all-time high stock market, well, we could have that late '90s reversal like we did, Charlie and Bob. You guys remember that, where they cut a little
Mhm.
early and then they had to go the other way. I mean, my SOFR Z7s there's like almost no cuts left in there. Like, okay, so Charlie and I agree that there could be a credit cycle, and we're at peak earnings. So imagine what it looks like on the other side. And the only thing that could probably govern it is rates, right, Charlie? I mean,
Yeah.
or oil prices going to 200, or something like that. Like energy could govern it as well.
Yeah, I like, I know you're the Z7s on SOFR. I'm looking at the Z6s with their 96.30. I mean, there's no rate cuts. I mean, they're starting with building rate hikes. And, if this market does come unglued, we're going to be talking about rate cuts pretty quickly. And what is interesting, the nomination of Kevin Warsh from the full Senate was supposed to go on this week, but they're on recess, I believe. So it's going to happen next week. I would not be shocked if Trump abandons his push against Powell, because he needs another seat there. And if he can get Powell to agree to leave on the agreement that he doesn't pursue, or Gene Perot doesn't pursue a case against Powell, I would not be shocked if they try and pull that off ahead, way ahead of the midterms. And then you got, the Lisa Cook Supreme Court ruling, which is probably going to come in before, June. That could get him another seat. So if he gets Powell out and Cook out, he could really control, between Warsh, Bowman, Waller, and then these two other seats, Powell and Lisa Cook. He could control the Fed by June. And therefore, rate cuts, become a reality in my mind. So,
I mean, it's tough to argue for rate cuts right now, though, right? Like, stock market's all
yeah,
time high. We're in a huge capex boom. Like, the deficit spending is outrageous. Like, I don't. I mean, like, I hear you that like some part of the economy is weak, but like maybe I've been talking about that more and more. Is that I think like the old model of thinking is being challenged, where if you're not in the funnel of this capex boom, you're not in the funnel of the deficit spending, the world sucks. Like you're on the bottom half of the K or whatever. Like and if you are in the flow, things are great. And it's tough to then apply one rule to the entire economy where there's like a bifurcated bimodal distribution. So I hear what you're saying, but like I don't know. Like when I look at foreclosures hitting all like 6-year highs in housing market being weak, at the same time it's not for everyone. So like how do you generalize one policy for an economy where the majority of the impact is from a small percentage? You know what I'm saying?
I think you're confusing fundamentals with politics, Ben. I mean, I think a rate cut would be more politically motivated, in ahead of the midterms than fundamentally justified. Um, I really think that Trump is going to try something dramatic, related to rate cuts, affordability, housing. I'm starting to look at some very, very select real estate situations. I mentioned last week's Essex property, ESS. It's a multifamily play with a West Coast geography. And the multifamily starts are such that you can anticipate a shortage in 2 years' time. And Essex has big position in San Francisco and Seattle and the West Coast, and there's going to be a shortage there, and rents right now are much more justified. It's more justified to rent than it is to buy right now. So I think rental properties, multifamily rental properties, are going to be a place to be. I've also mentioned Flagstar, which is, we're starting to see properties move and clear at written down values, at least in the banking industry. They've been more aggressive than private equity, but so we're seeing a clearing, taking place, and so turnaround situations like Flagstar, FLG, appeal to me. So, and obviously, what I'm anticipating is maybe it's more for show than it is for, because Donald Trump is the master of promotion, but I'm expecting that they're going to do something on the housing front and the affordability front. I'm intrigued by the fact that Fannie and Freddie are I bought those, on the dip back in March, early April, and I'm up over 100% of my positions in Fannie and Freddie. So there's something going on that has got people looking at affordability as a theme, I guess. And I understand the difference between politics and fundamentals, and this to me is more of a political play than it is a fundamental play.
Yeah, but I think that I think politics are part of fundamentals now. I think that I was talking to somebody the other day, or maybe it was yesterday, the disconnect that a lot of people who were, grew up and operated in the pre-GFC when capitalism was very much alive, and the post-GFC, and especially the post-COVID in this fiscal dominance world is, and I had a long time where I struggled to adjust to it, is the reality is the government is heavy-handed. This is a manipulated, managed market. Like whether you like it or not, that's a reality. Okay, and it's just the free hand in the market. It just doesn't exist like it used to. Whether it's tweets or it's the Fed plunge protection team or just whatever. There's just politics are part of the game. And it just is annoying, but it's true.
Yeah,
you're right.
On a completely different subject, I just want to mention this quickly because I wrote about it this weekend, and that is, how you define a problem determines how big or small it is. And I learned this back in my days of following the Texas banks in the early 80s. When they started defining the energy problem as only 12% of their loan portfolio, it was very narrowly defined by the Texas banks. It eventually became 30 or 40% of their portfolio as the definitions changed and evolved. And that's kind of where I am with these private equity, entities. They're defining their problem, or the analyst community, I should say, is defining the problem as an NDFI problem or as a software problem. And any problem asset starts off narrowly defined and then grows from there as the cycle plays out. But one of the areas that I think deserves more attention as a potential problem area is the healthcare services area. And we had two, credits recently that surfaced in private equity. One was a company called Affordable Care, a DSO, Dental Service Operation Organization, and this is, there's no hard assets here. It's a service organization, and these service entities are just as vulnerable to AI as software is. And for example, I think there has been talk about AI setting up at-home care programs that allows a patient to bypass a hospital with just a periodic visit from a caregiver or a nurse. There have been some, I know one of the things that private equity has been having trouble is exiting some of their life science investments. And that's because AI has created some life science startups. There's also regulatory issues as well, but it's causing problems in the life science area for the private equity. And I've heard, and we'll see where this ends up, the banks are now in the process of reviewing their healthcare portfolies, not just theirs, but the ones that they've lent to in the private equity space. And so I did do a review, a search of some of the major healthcare lenders. It's not a huge piece in the private equity, but you're starting to see names in private equity that are related to healthcare services being written down. Some of the names I wrote about this weekend were Affordable Care, AmeriVet Partners, Path Group, Pet Vet Care Centers, and Dental Care Alliance, in addition to some of the other names I mentioned. And there was a medical device company as well that surfaced as a very public write down for some of the private equity names. So the idea that AI can disrupt just software as strictly defined is probably going to broaden out to it also can affect other service type companies, healthcare being one of the areas that's going to get some scrutiny, I think. For what it's worth, some of the banks that have specialty lending groups related to healthcare. By the way, in this report, I do show what the healthcare exposure is for banks. It's about 3.5% of the total loans. It's not a huge outsized exposure for commercial banks, but there are some banks that have specialty operations. Probably the best known is Live Oak Bank, symbol LOB. And it's something that one should go take a look at. First Bank of Colorado, which is recently bought by PNC, also has a specialty healthcare lending facility. Fidelity Bank, symbol is PDGC in Pennsylvania, and Bankwell, which is BWFG of Connecticut. So they're in Connecticut. These are all banks that have specialty healthcare, and Capital One also has a specialty small business healthcare lending portfolio. So, these bear watching and monitoring, because I think that's the next area beyond software that is going to start to show some problems.
All right. Bob, you got anything else for us today before we sign off?